You see, developing sound financial strategy may help keep you from being stampeded into making poor investment decisions, especially during uncertain times. There are three main considerations to bear in mind when developing a sound strategy. You need to have a clear understanding of your investment and objectives. You need to know your investment time frame, and you need to understand your risk tolerance. So let's look at each of these considerations in a bit more detail. The first step of developing a sound financial strategy is to establish your investment objective. For example, what are you trying to achieve by investing? Are you working towards comfortable retirement? Are you trying to save for college education for a family member? Do you want a cabin in the mountains? Do you want a trip around the world? Your personal financial goal will basically help determine the appropriate mix of assets for your investment portfolio, depending on which objective you're pursuing, such as preservation of principal, income, growth, and or tax benefits. The second element in developing a sound financial strategy is your time frame. You see, the amount of time you have before you need to accomplish your goal can have tremendous impact on the investment categories you choose. That's because fluctuations in the financial markets can actually affect the short-term value of certain types of investments. If, for example, your goal is saving for a down payment on a house in the next year or two, your goal is a specific amount of money and your time frame is very short. Therefore, you wouldn't want to invest all your money in aggressive investments that carry a lot of risk. You simply wouldn't have time to recover from heavy losses if they occurred. Now, retirees are especially vulnerable to market volatility. Think about what could happen if a bear market or a market downturn occurred during the early year of your retirement and you had a high percentage of your portfolio in stocks. That could be a disaster. Now, the third element in developing a sound financial strategy is your risk tolerance. You see, determining your risk tolerance means evaluating how much risk you're willing to take in pursuit of your financial goals, including the ability to watch the value of your investment fluctuate without becoming queasy. Generally, the more potential for growth offered by an investment, the more risk it carries. You see, volatility in the markets have tested many investors' risk tolerance and driven home the fact that risk is an essential consideration of a sound investment strategy. So how much risk can you stand? We develop a risk tolerance quiz to help you assess your own ability to withstand risk. There should be a link to download this quiz somewhere in this page. Investing always involves risk. Here are some of the most common types. Economic risk. It can affect some securities. For example, when the economy falters or global growth slows down, corporate earnings can suffer. Though some industries, by the way, and companies may adjust very well to downturns in the economy, others, particularly industrial firms, could take longer to recover. Another one would be market risk. Effects of most type of investments, stocks as well as bonds, when the market declines sharply, it tends to pull down the value of most individual securities with it. After a decline, the affected securities may recover at rates more closely related to their fundamental strength. A long-term investing strategy may help reduce the effect of market risk. Another type of risk, called specific risk, might affect only certain companies or industries. For example, management decisions, product quality, and consumer trends can affect company earnings and stock values. Diversifying your investments could help manage specific risks such as these. Bonds and other fixed income investments tend to be sensitive to changes in interest rates. So when interest rates rise, the value of these investments falls, and vice versa. We'll discuss this some more in detail later in this presentation. Bond yields are closely tied to their perceived credit risk, which is the possibility that the borrower will default, i.e. fail to make payment on any type of debt. Default obviously can result in losses of principal and interest, disruption of a cash flow, and collection costs, of course, can become a factor. And finally, there's inflation. The increase in the prices of goods and services over time. Inflation basically poses a threat because it can reduce your future purchasing power. For example, overly cautious investors who place their investments in traditional savings account may not earn enough to outpace inflation. And when you evaluate their return on an investment, it's always wise to consider the real rate of return, which adjusts for inflation. In a very real sense, inflation is the loss of purchasing power. So regardless of how quickly your investments are growing, they're always losing ground to inflation. Here are 4 common items and what they might cost in 20 years, assuming a 3% annual inflation rate. Now, I'm sure many of you still have lingering questions. So remember, if you're wondering something, it's more than likely that someone else is too. So let me know how we can help and send in your questions. And by the way, if you want more information, we have a webinar on tax planning and retirement. And the link, by the way, is in the description. Many aspects of retirement will affect your tax bill in ways different than your working years. Our tax system is confusing and it treats various income types differently and contains hidden taxes and penalties. This webinar will discuss key tax issues you will need to anticipate. See you in the next video.